So recently, we removed Semirara or SCC from our stock picks. Okay. The reason why we removed it is because we learned that its coal mining business continues to face challenges. So when we talked to the company, we learned that its fourth quarter numbers will remain disappointing because it had some challenges in exporting the coal to Chinese customers. And coal prices right now remain depressed. So that should also hurt the 2019 earnings of the company. That said though, if ever you do own the stock and you want to keep it, we feel like it's fine because we think that the share price has gone down a lot and this negative is already priced in. Okay. The stock, after all, is very cheap, currently trading at 8 times PE, and it provides a 6.4% dividend yield. Okay. And it still provides 50% upside to our fair value estimate. And this is after factoring in all the negatives. The main reason why we removed it in our list is because the problem that it's encountering right now is because of depressed coal prices, which we think may persist for a long period of time because the drop in coal prices is due to two factors. One is the global economic slowdown, and the other is because there's an oversupply due to overproduction from Australia and Indonesia, and the oversupply problem may not be resolved in the near term. So we don't know when share prices of SCC will recover. It might take a while. So that's our only concern. But we feel like, valuations are okay. So if you can hold on to this stock, then please feel free to keep it. There's no problem. At least you still get a 6% cash dividend on the stock. For the month of January, the index is already up by 7%. And there is a possibility that a lot of the blue chip stocks will become very expensive, that you can't buy anything anymore. So usually when that happens, we see a rotation into smaller cap stocks or value stocks. So in light of that, there are some stocks that we also like, but if ever there is some rotation, we could see some interest in the following stocks. The first stock could be MPI. Investors are concerned about the status of tariff increases for its toll projects, for its water project. But that said, the stock is really very cheap. At the current price, it's only valuing its subsidiary or Meralco, which is its stake in Meralco, which really makes it very cheap. Okay. Other value stocks that we like include AGI and FPH. Okay, these stocks are very cheap. However, since they're holding companies, usually the preference is for investors to buy the underlying stocks. For example, AGI's major subsidiaries would be Mega World, then it has RWM, EMP. So they're all listed. So generally, investors would prefer buying the underlying companies rather than the holding company. But then, if all of these stocks become expensive, then they will shift to AGI. Another holding company is FPH. Again, I think the focus might be on FPH first, on FGen first, which is the major subsidiary, before it goes to FPH. But then if there are no more stocks to buy, then maybe the interest will go to FPH. So other value stocks that could generate some interest could be Chinabank or CHIB and PNB. Okay. I think in terms of preference, again, investors would prefer BDO, BPI, Metrobank, Security Bank. But then if these stocks become more expensive, then there might be a shift to Chinabank and PNB because these two stocks are less liquid, and as such, they are not usually part of the normal radar screen of investors. Okay, so now I'd like to move over to some other stocks that have interest among our clients. So one of them is ISM. Okay, just want to share that The latest run-up was due to excitement over its victory or the awarding of the third telco license to the Mislatel Group, which of course includes ISM. Okay. However, I think that this is a sell on news type of stock because I think for the next few years, ISM will, being the third telco, will still encounter difficulties. It will continue to lose money first before it will become profitable because it will need to first spend on infrastructure and then second, create scale or create a big enough client base to become profitable. And this might take several years. And not to mention the valuation of the stock. So we did a little bit of backward computation based on the market capitalization of ISM. Currently, the implied value of its telco operations is around 290 billion pesos pala. So just to put 290 billion pesos in context, it's same as the market capitalization of Globe and also of PLDT. So it implies that someday the third telco can be as big as PLDT and Globe, which, from our experience in other countries, that usually is not the case. Usually, when the third telco comes in, it's a niche player with a market share of maybe 10 to 20%. So I think an implied valuation of 290 billion for the third telco license is a bit too much at this stage. So we feel like ISM is a little bit too expensive at this point. When we came out with our power sector report, we shared how we're not really too keen about the power sector because there is currently an oversupply in terms of power generation capacity in the country, which of course will limit the ability of power generation companies to expand and also their ability to sell power at a high price. That said, though, we feel like FGen, we have a buy rating on FGen. And what has changed recently, allowing the share price to go up, is first, it was able to secure contracts for its power generation capacity. So it no longer has any power generation capacity that it will have to reprice in the near term. Okay, the problem is if you have to reprice your power generation contracts during a time when there's an oversupply, of course, the buyers will reprice you at a very low rate. Okay, and recall that one of its subsidiaries, EDC, which is a geothermal power plant company, delisted last year. So as such, FGen became the only play on green energy after that. And finally, it found a partner for its LNG facility. So this reduces the risk that its gas plants would no longer operate come 2024 when the Malampaya becomes depleted. Aside from that, the stock is attractively valued as it's trading at only 7.4 times PE. So do we like the stock? Yes, we do like the stock. We just don't like the sector. So that ends our list of stock recommendations for 2019. And also, I hope I was able to answer, the stocks that you have asked me to answer or, asked me for my opinion of what I think and what our team thinks about them. Thank you very much.